time focusing on the 2-year Treasury yield, 2-year Treasury bond, because it's been moving sharply lower here the last few weeks, actually a few months. And we'll talk about a little bit how it has an effect on the rest of the market, certainly the small caps. But let's take a look at the chart here first. You can see here that this to draw this parabola, you see that once we peaked out about 5% in the early part of May, end of April, it's been down ever since. It's been lower highs and lower lows. And now we're reached a point where there's a little bit of support here at the 4.45% level. But if that continues to move down, we can see a move much lower down to the 4.15% area, which we got to at the early part of January. Now, if you recall, back in January when yields fell sharply in November all the way down into January from about the 5.2% level down to about 4.15. It was the expectation of the Fed funds futures market that the Federal Reserve was going to be very aggressive on rate cuts. Of course, they didn't say that. What they said was that maybe one, possibly two rate cuts in 2024. The markets were saying, no, you're wrong. It's going to be 5, 6, possibly even 7 rate cuts in 2024. And eventually the markets had to dial it back to where the Fed is at right now. So we're kind of moving back to the return to the scene of the crime here, where in the early part of January, rates got a little bit too low. But the trend here is in place. And I think at this point in time, I think the market has it somewhat correct. I'm not exactly sure if it's totally correct. If we look at the Fed funds futures market, which correlates a little bit with the 2-year yield, the market is expecting now about 3 rate cuts in 2024. 2 in September and December are pretty much a lock. About a 56 or 60% chance of another one in the November meeting. Now, as we are here at the end of middle of July, there's only 4 meetings left in 2024 for the Federal Reserve. It's July, September, November, and December. And of course, we have the Chair Powell will probably be the headline speaker, keynote address in Jackson Hole in August. So I'm seeing some good things happening with yields and when they're coming down over here. Now, who is the big beneficiary of lower yields? That would be the small cap stocks, and we're seeing those small cap stocks like the Russell 2000 reacting in kind. And actually since last Thursday, July 11th. The CPI number came out and it was much softer than many expected. The PPI number that came out the following day on the 12th was a little bit hotter, but still that number that came out on Thursday, the 11th, was very positive for the small caps. And those small caps, the IWM rallied sharply, and that rally continues. Now, it's not anywhere near an all-time high. We're about 5% away from an all-time high on the Russell 2000, but certainly if we continue this trajectory down in 2-year yield towards, this 4.3%, listen, you know what? I mean, it's the rotation that's happening from large cap stocks and the small cap stocks. Large caps have had a great first half of not great first half in 2024. NASDAQ up about 20%, 21%. S&P 500 up about 18% so far in 2024. It's been a great year, but the Russell 2000 only up about 8%, and they've gained a large share of that here in July. Month to date, they're up about 7.5%. So we'll be watching this yield. This is an important yield to watch. And actually, if you look at terms of the spread between the 2s and the 10s, it's reached a level that we haven't seen in a low level, which we haven't seen in several months as well too. I think it's about 23 basis points differential between the 2s and the 10s. So the curve is flattening a bit. Yields are slightly coming down on the long end. They're coming down much more aggressively on the short end, which is taking away some of that steepness of the inversion of the yield curve. Hopefully that's helpful, and that's our chart of the week of 2-year U.S. Treasury yield. Have a great day, and I'll see you guys next time.